Okay, hopefully everybody can hear us. You've got me there, Travis. Excellent. It's 12 o'clock now, so we'll start in a minute or so. Just got a couple more people jumping on the webinar, so we'll start in the next minute or so, just to let a few people join. I know I'm always late to a webinar, Travis, so we'll give people a minute or so grace.
Sounds good.
Okay, Travis, I think it's kind of ticked over a minute or so past 12, so we'll slowly get into it. So I guess to formally commence the webinar. So thank you for all those that have made themselves available for our 7th and final webinar in the Lunchtime is Money webinar series. For those that have caught the previous 6 webinars, we hope you found them valuable. Today's session is on the topic of investing in a post-COVID-19 world. We're going to aim to keep the webinar to 45 minutes sharp. That will include question and answers. So we're happy to answer questions as we go. So please do, there is a Q&A box that you'll see on your Zoom. Please do pop any questions that you might have in the Q&A box, and Travis and I will do our best to answer as we go. And if we don't have time to get to it, we'll definitely come back to you after the webinar finishes. So we hope that the series of 7 webinars is hoped to give you a better understanding of the current climate, all things finance, and what's going on in this post-COVID world we're living in now. If you have missed any of the previous 6 recordings, they are available on our website and you can watch them at your leisure. So just for by way of introduction, my name is Nathan Lear. I'm a Director and Private Client Advisor here at Hewison Private Wealth. I also sit on Hewison Private Wealth's investment committee. So I love all things investments. I love talking investments, and I also do co-host the Money Mentors podcast along with my colleague Glenn Fairburn. So we put out a podcast every week or so, and our aim of the podcast is to improve financial literacy and awareness. And I'm joined by my colleague Travis. Welcome, Travis.
Thanks, Nathan. Hi, everyone. I'm Travis Schindler. I'm also a private client advisor with Hewison's. Like Nathan, I'm very passionate about investments too. And look forward to presenting on this topic today.
Excellent. Well, Travis, before we kind of get into the formal part of it, it's obviously been a big few days. Yesterday, we had the interest rate announcement from the Reserve Bank of Australia, rates left on hold. And then we had the federal budget last night.
Absolutely, and not to talk about a US president in and out of hospital with COVID. So there's certainly no shortage of headlines at the moment.
Any key takeouts from, we're not going to spend too much time on the budget today, Travis, but any key takeouts from last night's announcements?
Oh, look, the numbers are big, but with what we need as a country and to get people back in jobs and confidence to resume, hopefully it's a step in the right direction for us all. Excellent.
And I mean, obviously, we're both in Melbourne, so hosting this webinar, remotely from our homes, and it's a good time, I guess, in terms of, I say a good time, but numbers are starting to improve a little in Melbourne, and we're heading into spring and finals footy, Trav. So it's always a good time of year when the AFL footy finals roll around, isn't it?
Oh, not necessarily as a Carlton supporter, but for yourself, for Collingwood, particularly this week, hopefully for you.
Oh, well, you've got the draft, Trav. That'll keep you occupied. Okay, we'll move on. So 2020 has been, for many people, a year to forget. I mean, not everybody. I know there is silver linings out of all of this, but it's been a tough year for a lot of people, and COVID-19 has disrupted societies, economies, markets around the world. And I mean, arguably the biggest impact we've seen since World War II, which was obviously quite a long time ago now. But we did want to make the point that the world was already facing a number of challenges before COVID hit. The US election, I mean, it's been a long time coming. It's in less than a month now. That the fallout from that, what's that going to be? The US-China tensions, trade wars have been going on for a couple of years now, and other things such as Brexit. So there has been quite a number of things that were already distracting or causing issues for markets, and then we get COVID, which is just throwing a spanner in the works, really. But having said that, we want to touch on how COVID has impacted the Australian economy to start. And firstly, our GDP, or gross domestic product, which is basically the performance of an economy, how it's going. For the June quarter, we're down 7%. Now that's a huge fall. These are numbers we don't see a lot. But one point I did want to make is, compared to some of our global peers, that's actually not quite a bad number. So, for example, we've got the Eurozone is negative 12%, the US is negative 9%, and the UK is negative 20%. So, we're not the worst. Unemployment has obviously really spiked up. The economy is being locked down to hopefully stop the virus. So that's kind of ballooned out to 7% odd. We just mentioned the budget. So not unexpected, there's going to be a huge budget deficit for the 2020-21 year, which is expected to go to $214 billion. So, governments are prepared to spend a lot of money to fight the virus and boost the economy. And that has resulted in us going into a technical recession where we haven't seen a recession in Australia for almost 30 years now. So it's something that anyone under 30 probably hasn't experienced. And Trav's going to speak through the impact on the markets.
Yeah, so it's been quite a wild ride, 2020. Looking back to February and March, we saw Australian share markets begin their decline, hit as low as 37% at one stage. They have recovered since, but we're still seeing days of 2% moves on the market, whether that be up or down, which is not something we were used to in previous years, especially in Australia. US markets weren't out of the woods. They were impacted as well. They were down as much as 40%. They've recovered a bit more than we've seen in the Australian market, quite possibly because of major tech names like Facebook, Microsoft, Google. They tend to recover a bit quicker and maybe have actually even benefited from the COVID work from home environment. Regarding property, particularly in Victoria, with the restrictions, property, commercial and residential has been impacted. The residential market is really looking forward to opening up, hopefully sooner rather than later. But if you own a property and you do receive income from that investment, it's unlikely you haven't been immune from a reduction in income to some level. Some businesses are shut, or a lot of businesses are shut, so they're struggling to generate income to actually cover their rent. Hopefully, most businesses will survive, but unfortunately, you'd be remiss of us to think that there won't be some casualties, and particularly fixed income. Monetary policy globally around the world, it's the theme we've been seeing for a number of years now. It's been a race to the bottom with interest rates. So even before COVID came along, it was hard to generate interest on your savings. That forced a lot of investors to hunt for income elsewhere, possibly through property or shares. So given that theme we saw building up even pre-COVID, when markets did correct and quite violently, it wasn't a good feeling for many.
So the global government responses to COVID-19 has been unprecedented and quite extraordinary, really. One statistic that I heard last week was that the US government has in a space of months has put 3 times into fighting COVID what they spent on the Vietnam War, which was over a decade-long war, which was a big deal at the time in terms of how much the US government was spending on that. So governments have not been afraid to pour billions of dollars to fight the virus. Even the Australian government, obviously much smaller by US standards, I think they've spent $3 trillion plus on coronavirus. to fight coronavirus. Over the last 6 months or so, the Australian government has put about $257 billion in stimulus and assistance packages in just a short period of time. And obviously the budget last night is also, you know, going to blow out in terms of spending, but it's, you know, perhaps something that just has to be done to keep the economy going during these times. So and just on that point, a few people have said to me recently, how has the share market recovered so well? Because we saw almost a 40% correction in the share market from its February high down to the kind of the March lows. This all happened very quickly when it fell almost 40%, and markets have recovered steeply. And many people just don't get that. But one of the reasons behind that is the amount of money that governments are throwing into basically the system, and that some of that money will find its way into assets and has supported asset prices. So, and just a reminder, if anyone missed the start, there is a Q&A box. So very happy to answer any questions as we go along. So please pop any questions in, and Travis and I will do our best to get to them. So a couple of common questions we're getting, and there is, in my experience, there's a couple of different schools of thought in terms of which way the market and the economies can go. You know, a bit of a bull case, a bit of a bear case, depending on who you listen to and who you speak to. So as advisors, Travis and I get asked a lot of questions about what we think is going to happen, and a few of these questions are on the screen. So we just wanted to kind of pose these questions in the start, and we'll work through it as we go. So will the world go back to normal, or is this a new normal? Look, I think a lot of people think that the world is going to change now. I mean, we're definitely living in this COVID world, and it means that we have to adjust how we live our lives, and, you know, we're all working from home and things like that. So we'll get you to kind of reflect on that as we go along in terms of how that might have impacted kind of markets and how we go about investing. Another thing I know I get asked a lot, Travis, and I'm sure you do too, is now a good time to invest, or should I be waiting?
Very difficult to answer in the short term, but particularly from a long-term view. I mean, the risk of being out of the market, in our view, is far greater than being in the market. I'm sure you would agree with that too. So what is the risk of a further market correction, Nathan? Got your crystal ball there?
Yeah, look, as I've been saying to people, there's a lot of unknowns with this virus and a vaccine. I'm prepared for a bit of a roller coaster ride. I don't know, but I think I'm prepared in terms of maybe mentally for market jolts, and also how portfolios can handle that. And we're going to go through a couple of great examples to explain that. A lot of clients are asking about income, Trav. Income has been affected to some degree, hasn't it?
Absolutely. Look, we're naturally optimistic. Once there's a resumption of activity, restrictions are lifted, you know, thinking outside Victoria as well, more broadly across the country. Once confidence returns, we'd hope that flows through to company earnings and abilities for tenants to continue paying rent. So is commercial property a good investment going forward? Nath, what are your views on that?
I mean, I think commercial property is an excellent investment in any diversified portfolio. I think as humans, we do, you know, overreact to the current situation. And look, there's no doubt that commercial property has been impacted in the short term, maybe the medium term. But I think we take a long-term view with our investments. And Andrew Hewison did a great webinar with Chris Langford from Newmark Capital. I think it might have been, it was in the series. So I would encourage any listeners that want to delve deeper into this topic to have a listen to that one. And look, in terms of how will markets perform after a vaccine, look, hard one to know. I mean, you'd like to think that markets would go on a bit of a surge if there was a vaccine that was found, if there is a vaccine that is created. Arguably, some of that could be priced into the market. It's hard to know, isn't it, Travis?
Absolutely. So we just wanted to set the scene around and maybe try and define what the word normal looks like. Market corrections are normal. So a market correction is a fall of 10% or more. And since the GFC, we've actually seen markets correct 6 times. 2017 was quite an outlier of a year where we didn't see markets even fall 5%. That is not normal, and that's only happened 4 times since 1980. So as investors, we have to get comfortable with volatility and be prepared for it, particularly if we're investing in asset classes such as equities and property. So whether it's, in 2011, the sovereign debt crisis in Europe, or the US-China trade war towards 2018 and 19, uncertainty is normal. I mean, market corrections are also fairly common, as we show on the next slide. If we look at the two extremes on this graph, a 5% fall in markets is often going to occur at 3 times every year. So, you look back, you've done a 10% return on your equities for the year, let's just say, but you often forget that markets have often corrected 5% 3 times throughout that year. If we look at the other extreme, a 20% fall in markets, looking back through history, that on average occurs every 6.3 years. So from a long-term, investment perspective, we have to get used to these types of movements. What has been uncommon about 2020 is that the speed of the market correction that we saw. Markets fell almost 40% in a matter of weeks, whereas looking back through history, that generally takes more than a year to occur. So it has been quite an unsettling period. As investors, even a 5% move in markets is unsettling. So a 20% move within a matter of weeks did come as a shock to many participants in investment markets. So as we show, market pullbacks are more common than we think. The most important thing is what happens after a market pullback or correction, and that's often a period of strong returns. So since 1932, Nathan, we were just talking about this before, there's been 18 years where the market has fallen by 15% or more. So it is quite a common occurrence, but what does happen after that is a strong period of returns, as I said, and the average is about 55%. So on the left-hand side there, the light blue graph is the down period. The right-hand side is the recovery. From an investment perspective, the light blue is where we want to be buying, and then the darker blue, once the profits have come about in the portfolio, that's where we want to be trimming positions or taking profit. So look, it can often pay to stay calm and stick to a strategy during those light blue down periods that we see. And also sticking to a strategy when markets recover, because that's when we often look to take profits and really secure in those gains that we've made.
Excellent. Travis, we just had a question come through, which I think we'll have a go at answering. So thanks, Percy, for the question. I'll throw this to you, Trav, but I'll jump in. How do you see the valuation of property trusts in the foreseeable future? So what do we think property trust valuations are going to look like? So I think we're talking about listed property trusts there. Any initial thoughts on that, Travis?
Listed property trusts often are dragged down by market sentiment. So it's a bit difficult to distinguish between the movement of those actual investments versus the underlying assets that are underpinning them. But with our experience in property, got a good counterparty as a tenant of that property with a good long-term lease, and a good structure that's owning that investment, then we're seeing some pretty good outcomes longer term and seeing through 2020. Did you have any views on that, Nathan?
Probably, yeah. We're talking we're talking. Well, I'm actually not sure if we're talking listed property trusts or not, but I'll make the point that you can see listed property trust valuations be quite volatile, as we saw in March when the market was quite erratic, and the unlisted property trusts that we're more familiar with investing in for our clients. We've found the valuations are, I think you touched on this, Travis, but yeah, just to reiterate, they're much more stable because they are underpinned by the quality of the income now, or the rental agreements in place. Now, some of those rental agreements, well, not necessarily the rental agreements changing, but there is rent relief. So it is difficult to value a property perhaps in those situations, but I guess as anything, you really need to look forward for that long-term, I guess, performance of the tenant. And there's no reason why, the majority of properties, when I say majority, the majority of properties we're investing in for our clients, we don't necessarily see any long-term impact on the income or the tenant's ability to repay or pay that income. So I think, Travis, you'd finished on that slide. So just moving on, we wanted to So obviously Travis explained on the previous few slides that investing, can be volatile. We see market corrections are quite normal. So if you're investing in equities, you need to be prepared to see some volatility. But we wanted to kind of relate that to a Hewison client experience. And we just grabbed a portfolio, a Hewison client portfolio, just to see what's the impact been from COVID-19. And we saw, as per this line here, we saw in this portfolio a negative 13% fall from its February high to its March low. That happened very quickly in the space of a month. Compare that to the equity market that fell about 37%. So a diversified portfolio, as it should, will protect the downside. I guess what happens next is really important. It's the active management that really, in our view, adds the value. So, Hewison advisors would be rebalancing portfolios down here, and we're, as the markets have recovered, we've been able to participate in that recovery. And this portfolio, as we sit now, is down around 3% from its February highs, but it's actually higher than it was, at the start of the calendar year. Whereas over the same period, the Australian share market, including dividends, is still down almost 11%. So just wanted to kind of show a real life example of a Hewison client experience throughout COVID-19. Now, every portfolio is different. We do build bespoke portfolios. So the experience for every client is going to be different.
Yeah, just in the interest of full transparency, this portfolio had around 40% invested in equities. So understandably, you would expect it to fall far less than the market did. And Nate, did you want to talk about how we balance growth and dividend-orientated companies? Because we're not going to pick every winner within the share part of our client portfolios. But how do we see things transpire during COVID? Because obviously, company names like Ansell, ResMed, CSL, Sonic, just to name a few, they performed really well, and they helped offset some other companies in the portfolio that underperformed this year. Do any come to mind?
Yeah, look, the banking shares are a clear one that stands out. We've seen massive falls in some banking shares, a Telstra, things like that. So client, we're not going to pick all the winners. That's why we diversify. And there is some companies in the Australian market that are performing exceptionally well. Some of the ones you mentioned throughout COVID, and there's the ones that aren't. But once again, that's why we come back to that diversified approach across different sectors.
So look, this graph, moving into, we know that markets are volatile. We know that eventually good quality investments recover as well. But going to cash, and if you panicked in March, that did not work out well for you, unless you pick the bottom, a couple of weeks later to say, this is the bottom of the market, let's rebuy and reestablish positions. So eventually markets do recover. What we weren't expecting to see was the speed of the recovery. As Nathan mentioned earlier, the amount of money that central banks and even governments have poured into economies has really fueled that recovery. But far more money is lost by investors trying to pick the top and bottom of corrections rather than staying their course and having a strategy in place. So, what we've seen this year has been one of the steepest rallies in history. And it exposes to us, in our mind, the sharp disconnect between the economy and financial markets. That they're not one and the same. And
just on that point, I mean, dealing with a lot of clients and portfolios as we both do, by and large, I'd say the vast majority of our clients remain quite patient. I mean, when the market hit that bottom point in March, there was a few nervous people. We're not going to lie, but by and large, most clients understand the philosophy: buy quality, hold long term, rebalance portfolios. And by doing that, we're seeing a significant recovery. So, obviously moving to cash is not at the bottom of the market, although you don't know that at the time, is not the best move in our opinion.
So we wanted to spend a bit of time explaining the impact on income. One of our key philosophies is to focus on strong and reliable cash flow from the way in which we invest for our clients. But just to focus on the macro view to begin with, we've seen record low interest rates. As we said before, it's a race to the bottom with central banks. Companies on the share market, earnings have been reduced, and that's flown through to lower dividends to shareholders. Companies are holding back earnings so that they can protect their business, maybe pay down debt. Not all companies are seeing lower earnings. Some are outperforming, but in general, we're in a lower dividend environment. We've spoken about tenants of properties that may be struggling to pay rent or have deferred payments to the future. And that's also resulted in lower interest income. If you're keeping your money in the bank, gone are the days where you can just put a sum of money in the bank and expect to live off that interest income. But that does have an impact on investors.
So in terms of impact on income for investors, or say clients of ours, we've seen portfolio income absolutely has had an impact. As Travis mentioned, whether it's dividends or rental income on property, or even just lower interest rates on fixed income investments, which has been a bit of a thematic over the last few years. We've probably seen income come down in maybe the range of 10 to 20%, really depending on the portfolio. Look, hopefully this isn't a long-term reduction. It's just more of a short-term impact, but ultimately time will tell on that one. What does that mean for our clients? Look, for our clients that are living off the income from their portfolios, of course you don't like to see a slight reduction, but we have found that a lot of our, say, retiree clients, their expenses have come down, so perhaps they can cover that. And look, it really depends on how much income you're drawing from your portfolio. If you're living on the edge and drawing all the income that your portfolio generates to live, well, there might be a bit of a reduction in income. You might have to touch on or draw on the capital for a period of time, but once again, we take that long-term view, and hopefully income will return to kind of pre-COVID levels. So just on protecting the downside, on the example we showed before of a Hewison client, I think we kind of demonstrated that that's definitely something that we can do. I mean, I say to clients all the time, this is an extreme, market event that we might not see for a long time, a fall of this magnitude. I mean, we had the global financial crisis about 12 or 13 years ago now. You don't see these types of market falls at this level too often. So portfolios across the board have held up extremely well. We build bespoke portfolios, as I said before, so every portfolio is different, but generally we've felt that clients have been extremely grateful of how their portfolios perform. We often get a lot of feedback in review meetings. I know I've had a few review meetings where the clients have said, I've actually been a bit scared to look at my portfolio. Then I tell them or show them that it might only be down a couple of percent, and they're so surprised and grateful of that. Just a reminder, if there's any questions, feel free to pop them in the Q&A box. We'd love to answer any questions that you might have live. So in terms of how has COVID-19 changed how we invest? So I guess we like to learn our lessons from, all different market environments. And, one example that kind of springs to mind was when the global financial crisis hit, we saw the share market fall about 50% from high to low. And it did kind of result in us changing a few things, tighten up our investment, policy a little bit and how we invest. And one example was listed investment trusts, or listed property trusts, I should say, or LPTs, where they fell by, I think 70, 80% across the board. So for example, out of that, we reduced our exposure somewhat for more real property that didn't have the volatility of the listed property trusts. So it's still early days in terms of COVID. It's still around. We're still living with it, but it hasn't really changed our style of investing. We build, high quality, diversified portfolios, bespoke, designed to meet client objectives, focus on income and protecting the downside. So by and large, we think that we've achieved those objectives there, and we don't really need to change how we invest a great deal.
So I think you've just answered it, Nathan, but has the conversation around the table as part of the investment committee changed? And an extension to that, maybe have the conversations you're having with investment providers changed as well?
Yeah, the conversations with the investment committee, I mean, we had to work pretty hard kind of, the last 6 months and make sure, I guess, really be across every investment. and just probably tighten up a couple of things. But by and large, we're not, once again, just to reiterate, we're not really changing our style, because once again, they're long-term portfolios designed to withstand whatever the market or the economy or the world will throw at it. So so by and large, we've been very comfortable with how portfolios have performed. So just wanted to kind of loop back to these questions we asked at the start, because we've been reflecting on how, as Hewison Private Wealth, how are we going to position portfolios, for the next 10 years? Like if COVID does linger for several years, like how are we going to invest for our clients? So will the world go back to normal, or is this a new normal? I think that we've all adjusted to this COVID world, living in this COVID world, but in terms of how we invest, really it's the same investment approach, maybe just tightening it up a little. Trav, I think I asked you at the start, is now a good time to invest, or should I wait for opportunities? I think you had a good graph that maybe showed the danger of waiting.
Yeah, the danger of waiting is missed opportunity. I'm not saying whether it's a good time to jump into the market all at once today, but it's always a good time to have an investment plan in place, and knowing what you're going to do if markets behave one way or another, whether up or down. So look, it is always a good time to make sure you've got your objectives understood, and that you've got an investment plan that is aligned to achieve them. The biggest risk, and Nathan, I know you'd agree with this, and so would the other advisors, is to not have alignment between your objectives, your investment strategy, and the actual investments you're seeking to achieve them. Because if your expectations are, you want to buy a house in 2 years, but you load up your money into the share market, well, the outcomes can be quite dire.
Definitely need to seek advice on those type of matters. But in terms of, is now a good time to invest, or should I wait for opportunities? I generally say the best time to invest is now, with the right strategy. That's the key point, with the right strategy. And if markets are volatile going forward, if there's third, fourth waves, whatever you want to call it, and markets react and jolt, that's opportunity. When the market bottomed and towards the end of March this year, there's some crazy buying opportunities. And if you've got a diversified portfolio, you've got the ability to rebalance, you'll be able to do quite well out of that going forward. So that's probably how we would answer, that question in this COVID world. Trav, the risk of a further market correction.
I think we've demonstrated with the slides earlier that the chance of that's high. On average, once a year, the markets fall 10%. And on average, they fall 5% 3 times a year. So these things are normal. It's about being prepared for it. Whether it's going to happen, in the next week or two or not, no one can answer. Nate, did you have any views on that?
Yeah, look, once again, we can't. We don't have a crystal ball. We can't predict the short term. We take long-term portfolios, or build long-term portfolios. Income, we've gone through income from investment portfolios. Will it be lower forever though?
As I said before, we're naturally optimistic. It just highlights the danger of focusing solely on income when making investment decisions. As advisors, how many times we've put forward potential investment recommendations, and focusing on that income piece alone can be fraught with danger, because there's so many other pieces to the puzzle.
Commercial property, I think we touched on that. I think commercial property is a great addition to any diversified portfolio, in particular the property part of the portfolio. I wouldn't want to be too reactive to what's going on, and think that no one will want to ever work in an office again. I know our staff are pretty keen to get back into the office, and we're all social beings. We want to interact with other people. So absolutely, a good part of a diversified property portfolio. And Trav, how will markets perform after a vaccine?
I think it's easy to say that markets will like a vaccine coming through. As you touched on before, though, news like this is often baked into markets, and it's difficult to say how much of that is at this point. But one thing we would say, the danger of basing a strategy on binary outcomes, such as yes or no to a vaccine, is fraught with danger, because the vaccine could be 3 years away, it could be 2 months away, depending on who you listen to and what you're reading.
And just a final point on this slide. Will the world go back to normal, or is this the new normal in terms of how we invest? I mean, at Hewison Private Wealth, we've been doing this for over 30 years. I've mentioned earlier, we've been through a range of different market events. From as a company, we've seen the '87 stock market crash, we've seen the GFC, we've seen the tech wreck. There's been a number of different challenges for the market, but every time portfolios have been resilient. It's a tried and tested approach. So yes, we're living slightly different, but in terms of how we invest, we don't think it's a good thing to completely throw out your investment strategy and start again. We know what we do works, and we have absolute confidence in it.
So how to generate returns in a post-COVID world? The answer is, how do we tackle uncertainty? The answer is diversification. So we'll continue to include, these 5 asset classes in our portfolios. What we won't be doing is picking one over another or one sector of the share market to perform better than the other. Continue to keep things simple, sticking to a strategy of where markets are underperforming. That's when we'll look to buy. When markets recover, we'll look to take some profits and reinvest elsewhere. Having a nimble portfolio, particularly through fixed income and adequate levels of cash. Cash is particularly important in the current environment where income might be decreased a little bit. Well, that's where cash comes in to maybe plug that gap if it's needed. Ultimately, as advisors, we're rebalancing as markets move, and particularly making sure our clients aren't forced to sell investments when markets are depressed. So the answer that we'd like to leave you with today is a balanced approach is the way we see things in a post-COVID-19 world.
Just a final call for any questions. If there's any questions, we'll get you to whack them in the Q&A box now. We'd love to about to kind of wrap up in a minute. So if we see any come through, we'll jump on them. If not, Travis, before we kind of close, and we'll see if any questions come through, I did want to ask you a question without notice. I'm sure you'll be fine though. There has been a lot of talk about some valuations of some technology companies, and in particular out of the US, your FANG stocks, Facebook, Apple, Netflix, Google, these types of companies. Any thoughts on that, whether these valuations are substantiated or not, or whether they're in for a bit more pain ahead?
I think it's difficult to answer, particularly in the short term. A lot of these companies have got business models that have been able to adapt through 2020. So being nimble in their approach, their thinking, their cultures, and particularly the service offerings that they provide. I mean, the work from home environment has really played into the hands of a lot of those companies, operating on the cloud, doing meetings like this through Zoom, hosting webinars. So a lot of the themes we've seen come out of 2020 has really played into their hands and potentially closed the valuation gap. But in saying that, as you mentioned at the start, massive amounts of money in the economy through lower interest rates could potentially put a floor on any valuations.
Absolutely, and it's one thing that I've been kind of thinking about in this space lately is just the valuations for some companies. Like there's been companies like Tesla or even Afterpay in Australia where so much good news is baked in to their price. They really need a lot to go right, and if the market or if their earnings don't quite hit the spot, they could be in for a fair bit of pain. So I think it just shows the importance, once again, I know it might sound a bit boring, like a broken record, but the importance of diversifying across sectors. I know in Australia we don't have a lot of technology. We're not really known as a technology heavy share market. We actually are dominated by the banks, and the banks have not been great performers over the last kind of year or so. So once again, that message of a well-rounded, diversified portfolio is key. And I think, Travis, you're going to kind of look to close there.
In closing, thanks, Nath. Well, thanks to all of our attendees for joining us today, and particularly over the past 6 weeks as we've hosted our Lunchtime is Money series. We hope you found today's content valuable. And please don't hesitate to contact Nathan or myself directly if anything we've spoken about has resonated with you, or you have any questions. You can contact us on LinkedIn or email, or our details are found online. Please keep a lookout for an email which we'll be sending, which will include a survey. We'd love to hear your feedback on the past 7 weeks of sessions. We've certainly enjoyed presenting to all of our clients, prospective and current clients, business contacts, and anyone else who might be online. And we'll also be sending you the recordings. So if you missed out on the start of today's session or any of our previous sessions, we'll send you those links which you can look at your own time. So it's crazy to think that we're already in the final quarter of 2020, but we do wish you much success and all the best for the remainder of the year. Thanks for joining.
Thank you everyone for joining.